Welcome to Allodium's webinar. We're happy that you've decided to join us for today's session. My name is David Brummelkamp, and I'm the President and CEO of Allodium Investment Consultants in Minneapolis. I'll be the moderator for today's panel presentation on cryptocurrency, what to know as a long-term investor. Before we get started, I'd like to take a minute to emphasize that this presentation is an educational presentation, and it's not intended to provide legal or tax advice. In addition to our standard disclaimer shown on this slide, I want to note a couple other caveats about our presentation on this specific topic. First of all, cryptocurrency is a rapidly changing and evolving landscape. Even though we took a long-term investment approach with this presentation, the content you hear today may not be relevant down the road. And though we may use the names of specific cryptocurrencies as examples, we are not recommending any specific cryptocurrencies. As of November 2021, there were more than 9,000 cryptocurrencies in circulation, and more are being created each day. We do not pretend to know how each will perform in the future. So now let me provide you with a brief introduction to today's presentation. Allodium's investment consultants have been fielding a lot of questions about Bitcoin and other cryptocurrencies over the past year. The cryptocurrencies that are being created using blockchain technologies have captured the imagination of the public. The development of blockchain technologies is a major development. The media has been very busy developing stories about the cryptocurrency mania. With this as a background, Allodium has been studying the various aspects of this cryptocurrency phenomenon so that we can have a more intelligent discussion with our clients. There seems to be two opposing views on cryptocurrencies. The first view of the optimists is that cryptocurrencies like Bitcoin will replace the traditional fiat currencies like the US dollar, the British pound, and the Swiss franc. The cryptocurrency proponents highlight the opportunity to make money if cryptocurrencies go higher. The second view, more skeptical view, is that cryptocurrencies represent a Ponzi scheme, or maybe something similar to the tulip bulb mania that peaked and then collapsed in 1637. The critics point out that P.T. Barnum liked to say that there's a sucker born every minute. The Bible says that a fool and his money are soon parted. Is cryptocurrency based on the greater fool theory, that you will need to find a fool to buy your cryptocurrency at a higher price? Are people using real money to buy imaginary assets? Why do we have to pay in US dollars to buy Bitcoin? I seem to remember that there were some investment promoters that have made money in the past by selling swampland in Florida. Or do you really want to buy a bridge in Brooklyn? Do cryptocurrencies reveal the froth and lunacy of a top in the stock market? Is it a scam? Our team has been studying the topic, and we want to share our research to help you to be better informed investors about this important topic. Now let me introduce you to our three panelists. Our speakers today consist of three of the members of the Allodium Investment Committee: Eric Hutchins, Derek Van Callaghan, and Saul Bauman. At Allodium, we are evidence-based investors, and we rely on facts and academic research in our investment decision-making process. As the world of cryptocurrency is rapidly developing, this research has been a very interesting exercise for our investment committee. Our panelists have done their research and put together a solid presentation on the things for you to consider when looking into cryptocurrency. In their presentation, they will try to address the most common questions that we have been hearing from investors over the past year. Today, we're going to address these 5 questions. What is Bitcoin? What is cryptocurrency? What is blockchain? Why should we care? And what should we do? We've budgeted 60 minutes for our formal presentation, with an additional 30 minutes for a question and answer period at the end. You can feel free to ask any additional questions during the presentation by typing your questions into the Q&A application in the Zoom chat box. I'll monitor your typed questions during the presentation, and then we can use them to ask your questions of the various speakers in the question and answer period at the end of the presentation. We've also created some educational documents that you can request at the end of the question and answer period via email. We did one handout on cryptocurrencies and another handout on blockchain, trying to get these ideas into very succinct one-page handouts. We hope that you enjoy the presentation. And now I'll turn it over to Derek, who will put this topic in the perspective of our long-term investment approach.
Great, thank you, Dave. One important thing to note is that this presentation on cryptocurrencies has been developed by our team, keeping in mind the main goal of our firm, that all of our clients experience long-term investment success. In order to achieve long-term investment success, you need to be a good long-term investor. A good long-term investor is someone who, one, is investing to meet one or more goals sometime in the future. This could be retirement, college, a second home, who knows? Number two, they take diversification seriously. They believe that reaching their investing goals requires a globally diversified, low-cost portfolio. Number three, they are evidence-based, meaning that they allocate capital to asset classes and strategies that have shown they can perform well in various market conditions and across an entire market cycle. And finally, number four, they focus on the things that they can control, such as their overall asset allocation mix, annual savings amounts, and spending. They don't get caught up worrying about things that they don't have control over, such as current market conditions, interest rates, or politics. One such thing that you don't have control over in regards to cryptocurrencies is watching other people get rich, otherwise known as FOMO, or the fear of missing out. There are always going to be people who make an obscene amount of money on some obscure cryptocurrency. You always have to remember that if you can make that much money that quickly, that you can lose it all just as quick. And people are a lot less likely to be as vocal about these types of stories. Now I would like to turn it over to Saul, where he will discuss the origins of cryptocurrency in further detail.
Thank you, Derek. We'll now discuss the origin of cryptocurrency. On October 31st, 2008, an online article was published with the title of Bitcoin, a peer-to-peer electronic cash system. It was authored under the pseudonym Satoshi Nakamoto, who claimed to be a man in his 30s living in Japan. Satoshi's true identity remains a mystery, and some believe it is actually a team of people. Regardless of Satoshi's true identity, in early 2009, Bitcoin source code was released. This created the first cryptocurrency and blockchain technology. Bitcoin proved to be an elegant solution that a group of people had been working on since the 1980s. With the proliferation of credit and debit cards, these individuals were very concerned about privacy. They were not comfortable with a bank or company being able to track all of their transactions and the information it told about them, their interests, habits, even location. This was a colorful group comprised of anarchists, libertarians, academics, programmers, and cryptographers. They wanted to figure out how to make an anonymous digital currency that was not reliant on one entity. There were many challenges of creating this new digital money system. Bitcoin was the first cryptocurrency to fully address each of these challenges. One challenge was to ensure money is not duplicated or spent more than once. The solution to this is to create a detailed ledger that tracks every Bitcoin's ownership and tracks when a specific Bitcoin is transferred to someone else. To make sure that the ledger was not reliant on one person, company, or government, Bitcoin's ledger is maintained across a network of computers called nodes. The nodes are constantly communicating to ensure their ledgers stay updated and identical. The final challenge was to figure out how to incentivize the nodes to put the work into maintaining the universal ledger. The answer was that the nodes would be rewarded for their work by receiving Bitcoins. In addition to maintaining the ledger, the nodes are trying to solve computational puzzles that reset about every 10 minutes. The first node to solve each puzzle receives a specific amount of Bitcoin. This process was termed mining, as it is analogous to miners doing work to obtain gold. This is how all new Bitcoin is created. This is how the Bitcoin blockchain works. If Jan wants to give Bob 1 Bitcoin, the request is sent to the network of nodes. Now, of course, their real names aren't used and they have anonymous account numbers. The nodes check that Jan's account has the Bitcoin, and if it does, each node records that Bitcoin as now owned by Bob. This and other transactions within an approximate 10-minute time frame are compiled into a block. At the same time, every node works to solve a computational puzzle associated with the block. The first node to solve the problem sends the solution along with the block of transactions to the other nodes. Each node confirms the solution and then adds the block showing the updated Bitcoin ownership to the universal ledger. Because the ledger is comprised of blocks added to each other, it is called blockchain. The puzzles that the nodes solved started out pretty simple so that a normal desktop computer could solve them. They are programmed to get progressively harder, and now specialized computers are used to mine Bitcoin. This is a picture of a Bitcoin mining data center in Canada. The number of Bitcoins that can be created is limited to 21 million. For the first 4 years, the winner for each block received 50 Bitcoins. The number is halved every 4-year period. Today, 6.25 Bitcoins are distributed per block. Under this predetermined schedule, the last Bitcoins will be mined in the year 2140. Now we'll talk about the logistics of using cryptocurrency. Once cryptocurrencies have been created, such as through Bitcoin mining, they can be purchased and traded. The way that most people purchase and trade cryptocurrencies is through cryptocurrency exchanges. Some of the better known exchanges include Coinbase, Binance, Gemini, and FTX. One thing to be aware of are the fees associated with using an exchange. There are often fees for transferring money into an exchange account, buying and selling cryptocurrencies, and transferring money back to your bank. Trading fees alone can approach 2%, as is the case with Gemini. Withdrawals from FTX to your bank account cost $75 for any amount under $10,000. Needless to say, these fees can add up. Another consideration is how to store and protect cryptocurrency. Borrowing a familiar term, cryptocurrency is stored in a digital wallet. Many users buy cryptocurrency on exchanges and leave it in the exchange's wallet for convenience. Now, it's important to know that cryptocurrencies are protected with passwords called private keys. With exchange wallets, you don't have the private keys to your cryptocurrency. You are trusting that exchanges will keep your private keys safe. Unfortunately, because exchanges can hold large amounts of cryptocurrency, they are prime targets for criminals. A second common approach is to use a wallet application on a smartphone or computer. These are often free to use and are convenient. Also, you have control of your private keys. The downside is that your keys are exposed every time you connect to the internet. If you get a virus or download a malicious application, a hacker may be able to access your private keys and steal your cryptocurrency. These vulnerabilities lead some cryptocurrency owners to use hardware wallets. These are physical drives similar to a thumb drive. The drives can be left unplugged from the computer until needed, so they are not exposed to the internet. Importantly, the private keys never leave the wallet, and the entire transaction validation is done within the wallet. These are not without their own risks, and some of the manufacturers have been hacked. Just like you can't hold euros in a Schwab account, you cannot directly purchase cryptocurrency in a traditional brokerage account. However, there are ways to get exposure to cryptocurrency in a brokerage account. These investments are broken into two categories: coin trusts and futures contracts. Coin trusts allow investors to trade shares in trusts holding large pools of a cryptocurrency. These investments trade like ETFs. The other category is Bitcoin futures contracts that are structured within mutual funds or ETFs. These investments own futures contracts on Bitcoin as opposed to actual Bitcoin. Both of these categories of investments can have fees as high as 2%. Also, their price movements are not always well aligned with the underlying cryptocurrency. For those that are charitably inclined, donor-advised funds owned through Schwab are now able to accept donations of cryptocurrency. Cryptocurrency has certainly come a long way since Bitcoin was first used to make a purchase. We are still likely at the early stages of cryptocurrency. There is little doubt that the technology and uses of cryptocurrency and blockchain will continue to expand. I'll now turn it over to Eric to discuss the current landscape of cryptocurrency.
Thank you, Saul. Let's take a look at the cryptocurrency landscape. In many ways, cryptocurrency reminds me of the early days of the internet back in the 1990s. One difference, though, is that things are changing and adapting even faster today than they did back then. As Saul explained, Bitcoin was not only the first cryptocurrency, it remains the largest. Last November, it peaked at a market cap of over $1 trillion. As you may be aware, cryptocurrencies are in the midst of a major correction right now, and Bitcoin's current market cap is about $700 billion. While Bitcoin hasn't taken off as an actual currency as many people predicted, its widespread base of investors make its primary use a store of value with some similarities to gold. So I'll explain that when a Bitcoin transaction occurs, computers work through computations which confirm the transaction on the blockchain. Miners are compensated with a small amount of Bitcoin, and this is known as a proof of work model, in that computers provide the proof for the blockchain through their work. However, there are drawbacks to this type of model. As Bitcoin's price has increased in recent years, many more Bitcoin mining companies have popped up to cash in. One big drawback to the proof of work model is its energy consumption. When hearing about energy consumption, your first thought might be to roll your eyes and think, can't be that big a deal, it's just a bunch of computers. The actual numbers, though, are pretty astounding. According to Digiconomist, a single Bitcoin transaction uses the same amount of energy as the average American household uses in a month. It's roughly 1 million times greater energy consumption than a credit card transaction. As this chart shows, the global carbon footprint of Bitcoin mining is greater than all of that of Israel and just below that of Norway, and it's growing every year. In today's push for energy efficiency and sustainable practices, this degree of energy consumption likely isn't scalable or effective for everyday type of transactions. After Bitcoin gained momentum, thousands of new cryptocurrencies have been launched. As Dave mentioned, the number has grown to over 9,000, with new ones being launched regularly. That being said, it's believed that the top 20 cryptocurrencies make up about 90% of the total market. The term altcoins refers to any coin that isn't Bitcoin. Next in terms of popularity is Ethereum. Many of you may have at least heard of Ethereum, as its pace of growth has been exceeding that of Bitcoin in recent years, and its market cap today is just under half that of Bitcoin. Part of the reason for Ethereum's dramatic rise is its use of the blockchain allows for what are known as smart contracts. These smart contracts are essentially programs that can do things. So instead of being simply a store of value like Bitcoin, it can utilize programs for things like peer-to-peer lending or gaming. Many of the other popular coins, such as Cardano, Solana, and Ripple, also allow for smart contracts and are much more energy efficient and scalable than Bitcoin. These utilize a proof of stake model, which doesn't require the same computing power as the proof of work model and uses approximately 99.95% less energy. Ethereum is currently on a proof of work model like Bitcoin, which has begun limiting its growth. When an Ethereum transaction occurs, there are transaction costs known as gas. Think of it like putting gas in your car. With Ethereum's growing popularity, these gas costs have gotten very high. However, Ethereum is undergoing a transition to a proof of stake model called Ethereum 2.0. Today, the Ethereum blockchain can only handle about 45 transactions per second. On Ethereum 2.0, though, it will be able to handle over 100,000 transactions per second. This massive transition has been a multi-year project and is one of the largest crypto undertakings to date. This will allow for cheaper and more efficient solutions for projects wanting to tap into the Ethereum blockchain. Before I talk about meme coins, I thought I'd point out that the photos we're using of these various coins are fictional. Every coin we're discussing today is a virtual coin. There are no physical coins. These are simply creations by the media so that there's some sort of visual representation. Meme coins, also known by some more derogatory names, are coins that have no real functionality or business purpose. Dogecoin and Shiba Inu are two examples. These type of coins have captured headlines as they've boomed and busted over the last year, with retail investors diving in and out of them. In some cases, they're reminiscent of a pump and dump stock scheme, especially as most meme coins trade for pennies or even fractions of pennies. Manipulators buy a coin, pump it up with wild speculation online, and sell it when others jump on board. This is one area that's been ripe for manipulation. You may have heard of the TV show called Squid Game. It's a Korean show that was released on Netflix in mid-September of last year and quickly became its #1 show. To capitalize on the hype, a squid coin was launched on November 1st of last year with the promise of being used in a future online game modeled after the show. The coin quickly rocketed up to almost $3,000 a coin in a matter of days. However, the coin's creators had locked down the ability to sell the coin until they themselves had quickly cashed out. Almost overnight, the coin's value went to zero. If you've heard the phrase rug pull or they got rugged, that's exactly what happened to the people that speculated on that coin. When you first heard of Bitcoin, it was likely referred to as an alternate form of currency. As we've discussed, however, there are challenges to using it for everyday transactions. For example, it's tough to make a large purchase with a currency that may rise or fall by 10 or 20% in a single day. Imagine buying a car and having the price increase by a large amount while you're sitting at the dealership. Or on the flip side, imagine being a dealer and selling a car and seeing your margin disappear due to a cryptocurrency's price fluctuation. To combat this problem, another class of coin has arisen called stable coins. If you think about meme coins being on the highly speculative end of the spectrum, these coins are on the other end. They are meant to have little price movement and are typically pegged to a reserve asset, such as the US dollar or the Chinese yuan. One key advantage to blockchain transactions is that it's a trustless system. Now, trustless may sound like a bad thing, but it's actually a good thing. Think about a loan with a bank. You have to trust that the bank will stay solvent and not go under in the time of crisis. Think of Lehman Brothers in 2008. With blockchain transaction, there is no middleman to trust. Transactions can happen securely directly from one person to another. Facebook launched a stablecoin 2 years ago named Libra, but it was so unpopular it was quickly rebranded to Diem. While it was panned at the time, stablecoins are becoming increasingly explored and tested as they can add efficiencies to the financial system, and many believe may be inevitable in the future. Think of the stimulus checks over the last couple of years. As more of the world moves electronic, the ability to instantly move money to individuals is attractive and allows for greater transparency, which may help reduce fraud. China has been on the forefront of cryptocurrency headlines. On the one hand, they've banned the use of cryptocurrencies and Bitcoin mining in their country. This was because they are heavily committed to having their own cryptocurrency. In late 2020, they launched a government stablecoin called the digital yuan. They've given away millions in digital yuan and are heavily promoting its usage ahead of the Beijing Winter Olympics that begins on February 4th. Currently, over 140 million Chinese residents have a digital yuan account, and nearly $10 billion of transactions have been completed with it. The United States hasn't been sitting on the sidelines either. Last month, Federal Chairman Jerome Powell asserted that stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated. And right now, they aren't. And just last Thursday, the Federal Reserve released a long-awaited 30-page report discussing a central bank digital currency. The report stated, while a central bank digital currency could provide a safe digital payment option for households and businesses, as the payment system continues to evolve and may result in faster payment options between countries, there may also be downsides. The Fed hasn't yet committed to a central bank digital currency, though they are clearly evaluating how to do so and what the risks might be. With the speed of innovation and change, policymakers are scrambling to determine how to properly regulate cryptocurrencies, while at the same time not get left behind as the world advances. While there isn't yet a government-sponsored stablecoin in the US, there are stablecoins pegged to the US dollar. And while the digital yuan has transacted about $10 billion, transactions in US dollar stablecoins already number in the trillions of dollars. Just behind Bitcoin and Ethereum is a stablecoin known as Tether that is pegged to the US dollar. It's the third most popular coin in terms of size and often has the highest daily trading value of all the cryptocurrencies. The world of cryptocurrency and blockchain can seem particularly intimidating because it often reads more like programming language than everyday language. Let's take a look at two of the more important blockchain advances that are increasingly gaining importance beyond Bitcoin, namely DeFi and NFTs. In my opinion, one of the more exciting areas of blockchain advances falls under the umbrella of DeFi, which is short for decentralized finance. Going back to the idea of smart contracts, these are programs written directly on the blockchain. Think of a traditional loan from a bank. The bank holds money from one party and lends it out to another party. There are inefficiencies associated with using the bank as an intermediary, overhead from bankers, staff, processing, and maintaining a physical location. Then you have the paperwork and time delays in processing a loan. Furthermore, borrowers and lenders are exposed to the risk of something happening to the bank. And many financial opportunities are only reserved to certain institutions such as hedge funds. DeFi is helping to streamline and democratize these opportunities. One easy to understand DeFi application is in the area of peer-to-peer lending. For example, you have a large amount of Bitcoin, but don't want to sell it and realize capital gains, but you'd like to earn some interest on it. You can use a DeFi application to directly lend your Bitcoin through a smart contract to other individuals looking to borrow Bitcoin. This is known as staking your coins. A borrower would put up assets to secure the loan, usually having to over-collateralize it to protect against a market drop. And the smart contract is dynamic, so interest rates automatically adjust based on supply and demand for the loans. The end result is that the lender now earns interest on her staked Bitcoin and does so without the additional fees and complexities of going through a traditional bank. This type of application is already available through many providers and across many cryptocurrencies and stablecoins. The area of DeFi will likely continue to see innovation in the coming months and years, and it may be a disruptive force to parts of the traditional financial system. You may also have heard of NFTs this last year, as they've garnered a great amount of media attention. NFT is short for non-fungible token. So what exactly is an NFT? Well, the definition of the word fungible means interchangeable. Think of a dollar bill. While a dollar may have different serial numbers, they're exchangeable for one another or for the same amount of goods. Non-fungible, therefore, means the opposite. It refers to something that's unique. The application of the blockchain is that a unique piece of property can be listed on the blockchain, and it is verifiable and transferable. Think, for example, of someone's house. Rather than a title being held somewhere out in the world, leaving it subject to misplacement or fraud, it could be securely recorded on the blockchain. While there may be future advances for transferring rights in real-world property, much of the hype around NFTs has been in the area of digital art and collectibles. An NFT piece of art by an artist known as Beeple sold at Christie's last March for over $60 million. It may be difficult to wrap your mind around why a digital piece of art that looks no different from the one you can download from the internet would be sold for millions of dollars. Think of it like a famous painting like the Mona Lisa. Like the image you can download from the internet, you can buy a Mona Lisa poster on Amazon, but the copy is little value. The original, however, is unique and extremely valuable. That same concept of uniqueness and transferability has led to a whole new world of buying and selling of these digital assets. NBA Top Shot sells short video clips of NBA plays, somewhat like a digitally numbered trading card. These clips differ in rarity, and collectors buy and sell them on their website. NBA Top Shot is now averaging hundreds of millions in transaction volume every month. So just how big are NFTs right now? OpenSea is the largest NFT marketplace and processed 97% of NFT transaction in the fourth quarter of last year. Think of it like an eBay for NFTs. Its trading volume has exploded in recent months and is now doing volumes of 146 million. Over what time frame is it doing 146 million? Monthly? Weekly? No, OpenSea is now averaging $146 million in transactions every single day. So when you invest in stocks and bonds, you likely have a good idea of the amount of risk that you're taking on. With cryptocurrencies, though, there are many more risks and challenges to consider, some of which may not even be known yet. The primary risk to buying a stock is price risk. It's the risk that the price will go down after you buy it. Most cryptocurrencies are even more volatile than stocks, and moves of 10 to 30% are relatively common. On top of this, many exchanges allow for leverage, some up to 100 times leverage. So when a pullback occurs, the leverage can trigger additional forced selling, which can lead to even greater price declines. Another difference from the stock market is that crypto markets are global and can be traded 24 hours a day. It's not uncommon for one of these large sell-offs to occur in the middle of the night, likely when you are sleeping. You may wake up on a Sunday morning to find that the crypto markets are in the midst of a Black Monday type of meltdown. Let's think about some other risks. Take a typical brokerage account like one at Schwab. Schwab is the custodian and responsible for safely maintaining your account and providing you with statements and tax reporting. If you were to lose your Schwab brokerage account login, it's not a big deal, relatively easy to restore. Cryptocurrency wallets, though, are a whole different ballgame. When you set up your security key or recovery phrase on a crypto wallet, it's unlikely that you can ever recover it if it's lost or stolen. That's 100% loss. One well-publicized story is that of James Howells, a UK resident. In 2013, James mistakenly threw away the wrong laptop, which contained his Bitcoin wallet. In today's dollars, his loss was approximately $300 million worth of Bitcoin. And his story isn't unique. Amazingly, it's estimated that as much as 20% of all Bitcoin has been lost forever due to misplaced credentials. Another risk are security breaches. Cryptocurrencies and exchanges are more susceptible to breaches. And in 2021 alone, there were at least 6 hacks of over $100 million. By comparison, the average bank robber makes off with just $5,000. With that type of risk reward outlook, it's apparent where criminals may be focusing their attentions today. And beyond hacks and security breaches, scammers are targeting individuals at a rapid pace. NBC News reported that scammers took home a record $14 billion in cryptocurrency in 2021, and crypto-related crime is up 79% over the prior year. In the past, you might get a phone call from a scammer with a plausible story to try to weasel your social security number out of you. Today's scams are often targeted at securing your cryptocurrency wallet key. You might be new to crypto online and get a direct message from someone asking if you need help. And while helping you, they eventually ask for your wallet key. And once they have that, your wallet's contents are gone and likely unrecoverable. Furthermore, with the pace of change in cryptocurrency, there are likely many more risks that we don't even know about yet. Let's look at some of the challenges that cryptocurrency is facing. We've already mentioned the huge energy consumption of proof of work cryptocurrencies such as Bitcoin. That high expense and environmental impact will likely be a major headwind for its future growth. Similar to this are high trading expenses such as gas fees. For example, current Ethereum gas fees can be eye-opening to someone not accustomed to them. For example, you may be trying to buy a $100 NFT on OpenSea, and if the Ethereum blockchain is undergoing heavy usage, you might be faced with more than $100 in additional gas fees just to complete the transaction. Some of the smaller cryptocurrencies may be able to process transactions cheaper, but as they've gained supporters and more usage, they've run into their own issues of scalability and performance. Inefficiencies such as these will likely drive innovation in the coming months and years. One of the earliest concerns was the ability for criminals to easily use cryptocurrencies to launder money. This risk hasn't subsided, and regulators are playing catch up in how to effectively regulate this new technological world. Government regulation is another potential risk. Think of China and its overnight ban on cryptocurrencies. If the US adopts their own cryptocurrency at some point, will they crack down on cryptocurrency usage or greatly increase oversight? Then there's tax reporting in the IRS. Say you own one Ethereum coin that you paid $3,000 for. Then you buy an NFT with it after Ethereum has appreciated to $4,000. That's a taxable event in the eyes of the IRS. Furthermore, if you sell the NFT a week later for another gain, that's another taxable event. Add to this fact, exchanges like Coinbase and OpenSea do not provide 1099s like a custodian like Schwab would on an investment account. You can see how difficult it can be for an individual to effectively track their realized gains and losses for tax purposes. The IRS has added a question of tax returns, asking if you have bought or sold any digital currency in the prior year. As they are starting to get more serious about enforcement, it's likely that we'll start hearing about major cases where the IRS goes after tax evasion for people with large unreported gains in cryptocurrencies or NFTs. In the end, every transaction is viewable on the blockchain. So if the IRS beefed up their expertise, they could theoretically track down large tax evaders. This leads to other concerns such as privacy. Where do the reaches of government to combat tax evasion and money laundering intersect with personal freedoms and privacy? Right now, there isn't any clear answers, and there's a lot more gray area than black and white. Likely with the advent of the internet, opportunity and risks abound. I'll turn things over to Derek, who will share some final thoughts.
Thanks, Eric. While we do take cryptocurrencies seriously, we do believe that investing in them at this point in time is more speculation rather than long-term investing. The main difference between speculation versus investing is the amount of risk that's involved. Speculation takes on much more risk than investing does. You can think of investing in a single cryptocurrency as being equivalent to investing in a single microcap stock with 2 to 3 times the volatility or riskiness. Yes, you can make a lot of money quickly if you time it right, but out of nowhere, you can lose everything you have gained and then some. To help you get over this fear of missing out that we talked about before, just remember Warren Buffett once famously said, "You do not have to swing at every pitch." At this point in time, we would not consider cryptocurrencies a good investment for your long-term investment portfolio, otherwise known as your third bucket. The main reason being that it is far too volatile when compared to stocks, bonds, and other alternative assets that your long-term portfolio invests in. If you do want to dip your toe into cryptocurrencies, it's important to have realistic expectations. While everyone hears about that one friend or relative who made $1 million buying Bitcoin 5 years ago, the odds of you becoming a millionaire solely on one cryptocurrency investment is very slim. You have to understand that you could lose up to 25% of your investment in the span of a few weeks, which regularly happens with these cryptocurrencies. If you do decide to buy crypto, we would recommend that you mentally segregate this investment into your fourth bucket, meaning that if you were to lose all of your money, it would not negatively impact your long-term financial plan. This could mean limiting your investment in crypto to 1% or 2% of your net worth and cutting that allocation back every time it exceeds, say, 4 to 5% of your net worth. This would be just like rebalancing your long-term investment portfolio. As always, with new investment opportunities and technologies, we will continue to monitor this space. There will continue to be advances in cryptocurrencies and DeFi. As this space continues to mature, there may potentially be cheaper, more investable, and lower risk investments in the future. Dave will now share some final thoughts before opening it up for Q&A.
Thanks, Derek. And thanks to the Allodium panelists for putting this presentation together. Eric, Derek, and Saul, that was a great presentation. Today we learned more about Bitcoin, cryptocurrencies, and blockchain. I think we can agree that you should pay attention to blockchain as it will be an important technological development in our society. The future of Bitcoin and cryptocurrencies are still a developing story. As for what you should do or what you should not do, this is a good conversation for you to have with a financial advisor who understands your personal financial goals and objectives. We hope that this presentation helped you to gain a better understanding of the world of cryptocurrencies. We would expect that you will be learning more about them in the future as this story continues to develop. Now we can shift to a question and answer session to ask our panelists some questions about the presentation. As we open things up for questions from the audience, we would like to remind you that we are by no means experts in cryptocurrency. The field is changing on a daily basis, and as we are learning as we go, and we'll continue to learn more about it in the coming months and years. That being said, we'll do our best to answer your questions. Please feel free to type any questions that you have into the Zoom application, either in the chat room or the Q&A box. And we'll start with a question for our panelists. I don't see any questions in the Q&A session or chat box yet, so I will ask Derek a question. With thousands of cryptocurrencies that are out there, how do I know what are good coins to buy?
Yeah, that's a great question, Dave, and that's a question that I get asked, personally from friends and family. And we mentioned that there's over 9,000 tokens in circulation. So trying to find the next big winner is kind of like trying to find a needle in a haystack. And I know for me personally, I own some of the largest coins by market cap just because they've been around a while and they're pretty frequently traded. So there's a lot of liquidity. I don't spend a whole lot of time researching new coins, but I do have friends who are interested in this type of thing. So if I'm talking to a friend of mine or someone I know that has much more knowledge on this subject than I do, and if they mention that there's a coin out there that they like for specific reasons and they started buying it, I'll oftentimes follow suit. However, if I purchase a coin like that I find via word of mouth, I always limit my investments to, pretty small amounts. I'm talking maybe $100 or so in that type of coin. And that's pretty much it, because I kind of look at that as, purchasing a lottery ticket. That coin could go to the moon. It could go to zero, but, $100 in the grand scheme of things, really isn't a huge deal.
Okay, great. Here's a question for Eric. Eric, you're the Chief Investment Officer at Allodium. Do you think that Allodium will recommend cryptocurrency investments as part of a diversified long-term portfolio in the future?
Yeah, I think this is kind of maybe one of the key questions that we talk about. I think Derek mentioned that at the moment, we're not recommending cryptocurrency as part of a diversified long-term portfolio. I think we're really in the early innings of this story. We don't feel as though there's proven investment vehicles that could be expected to improve the risk and return of a diversified portfolio. Now, that being said, change is happening quickly. So as things continue to evolve, we'll be monitoring them, and there may be more compelling or more appropriate investment options in the future.
Okay, great, thanks. Question from the audience is, why is there a limit on the number of coins and an end date after which no more coins will be made? So this kind of gets into the idea of, I don't know who wants to take this one about why, for example, in Bitcoin, why is there a limited number of coins out there?
Yeah, Dave, I can take that. So essentially it creates scarcity. So with something new like cryptocurrency, investors are not going to want to invest in something that they think can just be easily duplicated or is unlimited. So by setting up a system where it's limited, the number that's created, it creates that scarcity and potential value. So people know it won't be devalued just in the future just by creating more. Now, it's really interesting in Bitcoin's case, and it was coded in the software that the last Bitcoin will be mined in 2140. And I am not certain why that year was picked, and why there was a specific time frame. But what it does do is creates the understanding with everyone that wants to invest in it that this is how many are going to be out there, and everyone's aware of how much will be out and available at once. So we'll see where Bitcoin's at in about 100 years, 120 years, and if it's still viable at that point. So great question.
So just a follow up on that, Saul, is what happens when all the Bitcoins are mined?
Yeah, good question. So if you remember, the main incentive for mining Bitcoins is that if they solve these problems, they receive Bitcoins on a certain schedule that decreases over time. So in addition to the rewards for solving blocks, block puzzles, nodes receive a transaction fee. Eventually, after 2040, when the last Bitcoin is mined, there will be no more puzzles to solve to obtain new Bitcoin. So mining nodes will rely solely on those transaction fees. Now, at that point, things should look very different as far as electricity costs and what it takes to keep up with these different transactions as a node. So, it's impossible really to know what things will look like in over 100 years.
One thing I'll add to that as well is, so Bitcoin, for example, there are a limited number of coins. Other coins aren't necessarily that way. So we think back to those meme coins like Dogecoin. It's unlimited the number of coins that can be made of like Dogecoin, for example. And that's why those trade often for pennies and really aren't, I think about, there's a question in here on, a store of value. Why are these a store of value, or how do cryptocurrencies appreciate or depreciate? It essentially boils down to what Dave talked about right at the start. If, the greater fool theory, or you can only make money on cryptocurrency if somebody is willing to pay you more than what you paid for it. So they appreciate if there's greater demand, if people want to drive up the price. A coin like Bitcoin, there's a limited number. And so that scarcity, if more people want it, the price would naturally go higher. A coin like Dogecoin, where they can make really an unlimited amount, it's tougher to make a case that there's really any scarcity there or any business case for that.
Okay. Here's a question from the audience. I understand the value of blockchain technology, but I don't see the link to a store of value. Please discuss the pros and cons of the store of value. You want Eric or Saul, you want to take that one?
Sure. You'll have to shut me up because I'll take all these.
Yeah.
But in the store of value, this gets back to, there's a limited number of Bitcoin. People have decided that there's value to it. Often that comes around to the scarcity point. It's if you think back to Beanie Babies, at one time Beanie Babies were very valuable, and people waited in line and paid a lot of money for them, and people thought they were a great store of value. That changed, and overnight they were, over time they were close to worthless. Now, Could that happen to Bitcoin? You know, there really isn't anything saying that Bitcoin has to be worth more in the future. It's going to come down to, are people wanting to pay more for it or not pay for more? If all of a sudden nobody wants to buy Bitcoin, or it stops being used, or there's, you know, maybe there's better alternatives, and you know, Bitcoin can always go down in value too. So the store of value really there isn't any real inherent value to Bitcoin or other cryptocurrencies. They are, you know, they're a virtual currency. And so really their store of value only is tied to what people will actually be willing to pay for them.
So Eric, a follow-up question to that is, one question from the audience is, I do not understand how cryptocurrencies appreciate or depreciate, as the case may be. And I think the question behind this question is, most people understand stocks invest in businesses. You own a share of a business. If the business revenues and profits go up, the value of the firm goes up. So people generally understand that stocks are an asset class and bonds are an asset class, and bonds are an asset class because you get an interest rate. That's pretty simple. People understand the ideas of stocks and bonds. But now we have these cryptocurrencies, and why would they appreciate or depreciate? Because they don't have revenues, they don't have profits, they don't have they don't pay an interest rate per se like a bond. So where's the value in a cryptocurrency, and what would make the value of it go up and down?
Right.
Appreciate or depreciate?
Yeah, it's you know, I do think there are some similarities to gold. I mean, gold's actually a physical asset where cryptocurrencies are virtual. But you know, you think about, many of you have probably heard about Warren Buffett talk about gold. You know, he's never been a big proponent of gold. He said, you know, you got to pay somebody to, you know, mine it. You got to pay somebody to transport it, pay somebody to put it in a vault, pay somebody to guard it. And in the end, it really, you know, it doesn't generate any dividends. So, you know, he's all about investing in companies that are growing, are paying you dividends, or like you said, bonds, Dave, that are giving you a yield. And so inherently, cryptocurrencies don't have, there isn't anything inside of them or anything inherent where they should grow. They're not a growing business. It's essentially just, is somebody willing to pay more in the future than what you paid for today. Now, I did mention DeFi, and, you know, the world is changing, and, you know, cryptocurrencies are getting broader and broader, where, you know, there are cryptocurrencies right now where you can stake them and earn, you know, a much higher interest rate than you could at a bank. So there are more traditional type of financial, you know, where that type of cryptocurrency, actually you're earning a yield on it. So it's, you know, they're starting to become more of an overlap with what we'd see from more a traditional financial system. So inherently, there isn't anything built into cryptocurrencies that are making them go higher. It's going to come down to, do people see enough value in them to pay more than what people paid for them in the past?
Okay. One thing what I've been thinking about for the last probably 2 years, as I've been looking at this cryptocurrency environment evolve, about a year and a half ago, I made a list of all the people that thought that cryptocurrencies were good. And then I made a list of all the people that thought it was bad, and, you know, primarily billionaires. So people that thought they were, you know, somehow they made a lot of money. And there's two people that I keep thinking about. And I'm glad you brought up Warren Buffett, because Warren Buffett's partner, Charlie Munger, just says, like, Bitcoin is like, it's a speculative frenzy. It's all going to end badly. And then on the other hand, you have somebody like a Mark Cuban, who owns the Dallas Mavericks and made his money in the internet bubble back in the late 1990s. He thinks that blockchain is fabulous, and he's really into cryptocurrencies. So I have these two billionaires. They're both smart, but they have different opinions on this. But after a while, I realized that I think that they're both right. And the way I kind of get there is, if you go back to the development of the internet in the late 1990s, the internet was for real. And Mark Cuban at that time made his first $1 billion by being an entrepreneur in the internet age. And at the time, Warren Buffett and Charlie Munger just said, we don't understand technology, we don't understand the internet, and they didn't buy any of the internet stocks and startups in the late 1990s. And they avoided the NASDAQ blow up in March of 2000. But now we're looking at the same kind of concept where the blockchain is, to me, it's like a real thing. It's a technological development. And you really can't argue about the fact that the blockchain really is a big development. But where I think these two people probably agree is that blockchain is a great technology. But what Mark Cuban is looking at is saying, I want to like buy all the cryptocurrencies that are going to really be successful. And Charlie Munger is looking at it, he's saying, there's a lot of people that are buying cryptocurrencies and they don't know what they're going to do, and they're going to lose a lot of money, which is the same thing that happened in the internet bubble back in March of 2000. There were a lot of people buying internet stocks, but they really didn't know what they were doing. So what it kind of comes down to is, you know, and I would say, how, again, it gets back to our question about why should we care about this, and then what should we do about it? And why we should care, I think, is that this blockchain technology is really going to kind of be a transformative technology in our world. And so this is my long-winded question is, you know, simplistically, do I have to invest in cryptocurrency to retire comfortably? You know, and it's kind of this fear of missing out. And I don't know if Derek, you focused on this subject, but what if everybody that invests in cryptocurrency becomes a billionaire and I don't invest anything in cryptocurrency, and I'm kind of left behind, and I can't buy a new car, a new house because everybody else made $1 billion and I didn't? So I'm kind of bringing it back down to this question of, do I have to participate in investing in cryptocurrencies to fulfill my financial plan as an individual? And I'll let maybe Derek take that first, and Saul and Eric can chime in as they want to.
Yeah, no, I can definitely take that one, Dave, and I'm sure that there's a lot of people, you know, feeling that way about, you know, that fear of missing out. It's really tough to watch other people get rich and you know that it could have been you. You know, I would say at this point in time, cryptocurrency, the blockchain, DeFi, it's not something you need to invest in order to be able to retire comfortably. And the reason I say that is because, you know, stocks and bonds and alternative assets like real estate, commodities, gold, those aren't going away just because we have the blockchain and all these cryptocurrencies. You know, especially when you think of right now, how immature the cryptocurrency market is relative to, you know, the stock and bond market. Like Eric mentioned earlier, we're in the midst of a 50% drawdown in Bitcoin right now. And this is like the third 50% drawdown that we've experienced in the last 3 years. We've experienced one 50% drawdown in the past, you know, decade and a half in stocks. So with those types of wild volatility swings, I don't think it's something that, you know, needs to be in every person's portfolio and able to be able to retire comfortably. And you know, that could obviously change as this market becomes more mature and you know, we start learning more about it, and there's just easier investment options for you know, mainstream people. But you know, as of right now, I don't think it's something that you need to have to retire comfortably.
One good follow-up point to that And I see a couple questions too around, are there ways to invest in blockchain? Talking about individual stocks. One thing to keep in mind is those of you who are our clients know we believe in very broad diversification. So if we don't recommend 10 companies, we recommend thousands of companies. And one benefit to that is, most of these major companies are exploring blockchain, and the winners in blockchain, you think about the internet successes from the 90s, companies that came out of the internet boom like Microsoft, Apple, Amazon. If you own a broadly diversified portfolio, you own them, and you've owned them for many years. It's the same thing is going to happen with blockchain. There's going to be winners and losers. Some may be publicly traded companies, some may be initiatives within companies, and you're going to have exposure to those successes. So blockchain successes, you don't have to try to pick, this winner or that winner. So just a point, you are going to have exposure to, things that work in the blockchain just by being owning a diversified portfolio.
Another question that came in from the audience is, I heard that professional athletes are getting paid by Bitcoin in certain situations. Is this just speculation that the value would be more than getting paid in regulated currency? And why would someone do this if they can't purchase anything real with it? I'm gonna just make a social commentary here on what's going on when you read in the paper or you see on TV that some professional athlete is doing something. I think there's a company called Nike that, signed a contract with Michael Jordan to sell more shoes. And it ended up, they probably made a couple $100 million the first year he was in the NBA. The people that are positioned to make a lot of money by getting a professional athlete to do something, or any other, let's say, Instagram influencer, movie star, these people are being paid to market a product. And, if Bitcoin thinks that if they, pay an athlete to say that they're going to take 1% of their salary in Bitcoin, or maybe 100% of their salary in Bitcoin, that really does work as a marketing tool to get millions of people to say, hey, maybe I should go buy some Bitcoin because my favorite basketball player is taking his salary in Bitcoin. What you have to remember is that when there's a lot of money to be made, sometimes people are going to market that to try to get investors to do things. And you got, we always tell people, don't pay too much attention to what the people are saying on TV, because the television and cable moderators are trying to encourage people to watch the program. So they're going to always sensationalize what's going on. But there's also the advertisers advertise because they're trying to sell products. And so when you see a commercial, and I think it's Matt Damon has a commercial for crypto.com, and the commercial is basically, if you're an explorer and you want to become a successful explorer, you just got to be bold and take a risk. The whole commercial is take a risk and you're going to be successful. And so, I kind of look at the commercial and I say, oh, I better buy some Bitcoin because then I want to be successful. And, they're marketing to me to try to get me to buy cryptocurrencies. And so that is a big deal. It's going on with professional athletes, Instagram influencers, et cetera. Another question that came in is, a lot of the mayors in the cities are talking about promoting crypto, and maybe that they're going to start paying employees in crypto, or there's sports stadiums that are now being renamed. I think in Miami, they called the new stadium FTX instead of American Airlines. So American Airlines must have not have come up with enough money to like keep their name on the stadium. So now they've been rebranded as FTX. And FTX is a cryptocurrency trading platform. Well, why does FTX want their name on the stadium? It's marketing. And so all this stuff is going on to kind of market people, make people more aware of cryptocurrency. But I just want people to be aware of marketing isn't necessarily investment advice. It's not necessarily objective advice. And so you got to be really careful. And I say, go back to the internet bubble of the late 1990s when people said, wow, the internet, it's going to change the world. And they went out and they bought any kind of stock that had any kind of technology related to the internet. They didn't pay attention to valuation. They didn't pay attention to revenues or earnings, management. You know, some of these companies in the internet bubble came out, had really no value. They weren't really valuable businesses, but people bought them anyway because they were related to the internet. What's been happening here in the last year or two is a lot of kind of that crazy speculative behavior. And the thing that we have to be, you know, the reason we have to be very diligent is, while I would say blockchain technology is really important and it's going to change the world, that doesn't necessarily mean that anything I buy related to the blockchain is going to make me a lot of money. In fact, if I don't do my due diligence, I might end up losing a lot of money. So our approach to this, and I'm glad that kind of Eric mentioned it, is if you look at just a broadly based portfolio that has thousands and thousands of stocks, you probably already own companies that are doing work with the blockchain technology. I'm sure that Microsoft is doing something related to blockchain. I bet you that Visa is doing something related to blockchain. I mean, all these big companies already know about blockchain technology, and they're trying to figure out how to maximize their shareholder value by figuring out how to use the blockchain to make their businesses more valuable. So you indirectly already have exposure to this. What we've been trying to do internally is look at, what are these companies that we already own, and make ourselves more knowledgeable about the blockchain so we can understand how, portfolios or our companies will grow in the context of that development in the blockchain technologies. Another question that came in is, are there mutual funds and or ETFs for various cryptocurrencies? Eric, do you want to take that one?
Sure. Yeah, there's a couple related to that where, it's often somebody wants to maybe speculate on some cryptocurrency, but they don't want to have to open up, get a wallet and, open up an account and an exchange, and it gets pretty complicated. And so they kind of come back to, is there a mutual fund or an ETF I can buy instead? There are some ETF type structure, maybe I won't name any names, but there's a Bitcoin future, one that's based around the price of Bitcoin futures that was launched a few months back. Immediately garnered a whole bunch of assets because people are able to buy and sell that in a regular brokerage account. Saul talked about this though. They've got high fees, like really high fees, up to a couple %, and may or may not track the actual price of Bitcoin. They're using Bitcoin futures, and there's some kind of technical things where they had a similar ETF pegged to the price of oil in the past, and with oil futures, they found over time it really didn't follow the price of oil that much. So there's that risk that this Bitcoin ETF won't necessarily follow the price of Bitcoin. There's other ETFs that have come out where they're broader than just Bitcoin. So if you're kind of committed to buying a little piece in your fourth bucket, kind of that going with a more diversified ETF type approach that actually holds many coins rather than just one coin, that might be the way to go. Yeah, otherwise I saw somebody else asked about, what about buying a specific company, like a mining company, like a Bitcoin mining company. We try to avoid buying single stocks, just kind of opening yourself up to risks that you don't need to take. It's kind of like buying a single coin. Prefer to be diversified, kind of diversify that risk. And, mining companies too, you think about Bitcoin. Well, let's use Ethereum. I talked about Ethereum's moving to Ethereum 2.0. When that happens, Ethereum miners aren't really needed anymore. So companies that have built, to mine Ethereum, they're either not going to be needed or going to be needed to a very small degree. Something like that could happen with Bitcoin in the future too. So I'm not going to give any stock advice, but yeah, I don't know if buying a bunch of Bitcoin miners is the way to go at the moment if you're looking at buying stocks.
Another big, broader question is, in this kind of, I don't know how to categorize this question, but my question is, will Bitcoin replace the dollar? And before you answer, I'll let any of the three of you answer that question. But the backstory on that is that a lot of people are buying cryptocurrencies and maybe Bitcoin, as the number one example, in that they are worried about the Federal Reserve. They're worried about the government printing money pretty fast. They don't trust the government. They want to be independent of the government. So there's kind of a whole big movement about, and I don't know if it's a libertarian issue or what the issue is, but there's a lot of people that are really passionate about get your money out of the banks, get your money away from the government, don't rely on the US dollar anymore. And so my question, and I'll let any or all of the three of you give me your opinion on, will Bitcoin or any other cryptocurrency replace the US dollar as the primary reserve currency in the world or in the United States? Are people going to migrate away from using the US dollar?
My personal opinion is that there's I'll say a 0.001 chance of Bitcoin replacing the US dollar. Will US dollar stablecoin that our government, our central bank promotes and regulates, I think there's a pretty good chance that happens someday. Basically an electronic dollar that's pegged to the US dollar. So the US dollar, I don't think is going away, but will they essentially make an electronic form of it? I think, that a lot of people think that may be inevitable. I could definitely see that happening someday in the future. But yeah, a lot of the other things you said, Dave, about, you look online and there's a lot of, clickbait and a lot of people promoting, it was for years, it was, the last 20 years I've been hearing about this person or that person promoting gold because, the economy is going to come crashing down, and you look at different things online and it's kind of the same stories recycled over and over. And now they're kind of using crypto instead of gold. And, they're, like you said, with marketing, they usually have something they're selling. And I think we're going to be okay economy wise. And I don't see the US dollar going away anytime soon.
Derek or Saul, any opinion?
Yeah, no, I mean, I echo Eric's sentiment. I don't think the US dollar is going anywhere, but I certainly do think that there could be, like Eric mentioned, a US dollar stable coin that is kind of regulated by, our central bank, the Federal Reserve. So Yeah, Eric had a great answer that I don't have much to add to.
Yeah, I'd just add that, money does change. And, I have a dollar bill that is a silver certificate, and those were phased out in 1964. And you may have seen these. They say right on the dollar, you can trade this in for a certain amount of silver. And that's not that long ago. So will we see this switch in our lifetimes? I don't think so. But as Eric said, things do change, and something that was backed by the US government, I could see that in the future.
Yeah, I'll address two more questions. First is kind of on the costs of investing in crypto. One is that the viewer here has heard that even the expense ratios, while they might be low in a cryptocurrency ETF, but you get killed when the futures roll over and the trading costs. That's one question. And a related cost question is, if they have transaction fees to do transactions, let's say if the cost of buying a Bitcoin, if there's a transaction cost there, can they become unlimited? I think Eric might have talked something about buying something for $100 and the fee to buy it might be $100. Is there unlimited fees on some of these transactions?
On that, so if you're buying something, say with Ethereum, and I use the NFT example, most NFTs are traded in Ethereum. If you're going to buy something, it will tell you what the current gas costs are, and yeah, you'd be surprised how high they get. I use the $100. They can get a lot higher than that too. It will tell you before you actually make the purchase how much it is, but they can be pretty steep. So when we talk about the ETFs, their expense ratios might be 1% to 2%. Without getting too technical on how futures work, and I read one report recently that was talking about the Bitcoin futures ETF, that you may actually lose 8 to 10% of additional value based on the rolling of the contracts. And so we can get kind of technical on like what the rolling of the contracts means, and sometimes it can work for you or against you, but usually it's probably going to work against you. And so it's kind of like a hidden fee within the fund, where it's not an expense ratio, but it's you're not getting that same return you would if you own the physical asset like Bitcoin, for example.
Okay. I'll try to close it out with my last question here, but I'll also mention to the audience that we did develop two one-page handouts one's on cryptocurrency and one is on blockchain. And if you want to get a copy of those, just send me an email and I'll be glad to shoot you out a copy of those. My last question is going to be about resources, about how to learn more, because this is something that we're all on this path of learning, because this is a rapidly developing technology that we do believe it's going to be, an important technology, like the development of the internet was an important new technology for society. And so we're going to be learning more about this as we go into the next couple of years. And what Allodium will try to do is develop, resources that try to take complex subjects and try to simplify them for you. But my last question will be maybe to Eric on, what are some recommended resources if we want to learn more about this?
Right. Yeah, some of you may or may not know that Dave collects a lot of books. Dave loves books. And, in the past, if you wanted to learn about something like Bitcoin, you might order a book off Amazon, or you might go to the bookstore or the library. Hard to do that with cryptocurrency. If a book gets printed, it's probably out of date by the time it's actually, reaches the store. And so it's changing so quickly. There aren't a lot of, kind of the traditional resources. However, today we have a lot more opportunities to learn, and it can kind of be tailored to how you learn. And so there's several podcasts I listen to pretty regularly on Spotify. Many of you may have used Apple or a different podcast site. Some great podcasts on cryptocurrency. There's good blogs out there. There's good websites out there. There's online discussion forums. Discord. Some of you may be getting familiar with Discord. There's places you can go where you can learn, educate, and everyone's kind of learning together too. So it's there aren't, I don't think, too many crypto experts at the moment, because it is so ever evolving. So if you're interested, feel free to send me an email. I can send you a few of the podcasts I listen to, but that's kind of how I like to learn, is listening to podcasts.
Great. Well, thanks. That's enough question and answer for the day. We want to thank you for attending, and I want to thank our panelists, Eric, and Saul, for the work they put into developing today's presentation. Thank you for attending our webinar, and we hope that you found these ideas to be educational and informative. Please feel free to reach out to us if you have any additional questions about today's presentation. We will have the slides and a presentation recording available on our website on the events page of our website in about 1 week. Thank you and enjoy the rest of your day.